Thank you everyone for joining us. My name is Kelly Galanis. I am the Director of Operations and Donor Relations at STCC. We're so excited to bring you our second in the series of our Spring into Wellness events. Tonight, we are going to take a financial wellness checkup with Anthony Rondinelli, who is class of 1992 and Associate Professor of Business Administration at STCC, among many, many other hats that he wears. So we are so happy to have him joining us tonight. We would love to have you share your questions, your thoughts with us, and there will be a Q&A at the end of the session. So please feel free to write your comments in the chat, and I will be sure to do the Q&A after with Anthony once the presentation has completed. And of course, we certainly invite you to hop on and ask your question directly if you'd prefer to do that as well. So Keith, do you have the sponsor slide? Just wanted to thank our sponsors. Thank you so much. For our sponsors, without them, we could not have done this event. So big thanks to our gold sponsors, Bay State Health, the Collins Companies, and Smith & Wesson for their support and generosity. So thank you very much for that. I am going to now turn it over to Anthony, and we're going to get started. And there we go. We have to give our little shout out before we get started. Just wanted to say, stick to our plan. We are, of course, the #4 community college in the United States. How awesome is that? #2 online business degree program, best local college or university, 2020 and 2021, best 2-year college in 2020, and best 2-year college for adult learners in 2019. So always getting those awards and loving that. It's a great community that we're a part of, and we're pleased to bring you this programming tonight to kind of accentuate all the wonderful things that STIC is a part of. Without further ado, I would like to turn it over to Anthony, and we're going to get the presentation up and running. Anthony, go for it.
Well, thank you, Kelly. I'm so happy to be here tonight and to be with each of you. You know, what makes this time unique for everyone is that, you know, we've all been through COVID, and COVID has been a situation for us where it's taxed our physical health and our mental health. But how about your financial health? Because the COVID situation and all being remote like we are right now, that's had an impact on people both mentally, physically, as well as financially. Many people may have, over the course of the last 14 months since the pandemic began, you might have people, we do have people that have lost their jobs, that have lost a lot in terms of investments, and they may be strapped right now. They may be kind of stumbling and need to get back as we move forward and we get past the COVID situation and we get back to normal. It's important to take a look at your financial plan and get yourself back on track. And that's what I enjoy doing. I love teaching. I love STIC, my alma mater. And not only do I teach, but I also practice accounting, financial planning. And the most rewarding part for me is when I get to help people out of those situations and maybe help them get themselves back on track. And hopefully, if you're off track, our little discussion here tonight will help you get back on track. So let's talk about financial wellness. So what does it mean to be financially literate in today's COVID-19 society? What does that actually mean? Kelly? You can change the slide.
Sorry, it's giving me difficulties. I think it.
Oh, okay.
Sorry.
No problem.
That's fine. All right.
I wondered if I was on mute again.
No, my screen sharing is paused. There we go. Is that better? Can you see it now?
That's great. Thank you.
Awesome.
Let's talk about what a definition of financial literacy really is. Financial literacy is the confluence of financial, credit, and debt management, and the knowledge that's necessary to make financially responsible decisions. Decisions that are integral to our everyday lives. That's really the crux of what we're getting at here. Knowing a little bit about finance is important to everyone, not just business people, not just people in the healthcare industry. We're relying on those healthcare workers a lot these days. It's important to everyone. And it's important to have a basic understanding of what being financially literate means. So with that said, we now have a definition, and let's work into some facts about what it means in society today to be financially literate. Kelly? A couple of interesting facts. 40% of all the US households in the United States carry some credit card debt, with the average American household carrying a balance of over $5,000 in credit card debt. For only indebted households, which excludes people who pay their balances in full each month, the average debt is over $9,000. Try to conceptualize that number for a moment. The average debt, we're not talking about a mortgage, we're not talking about, we're talking about credit cards, things of that nature. And people are in debt $9,000 on average. That's a lot of money, okay? In 2018, the average federal student loan debt per borrower was $33,460. Most of the federal student loan borrowers, over 70%, owed $40,000 or a little bit less, but more than 2.7 million owed $100,000 or more in student loans. That number, I don't know how you feel about that, but that number blows me away when I think about it, because when you think about how necessary an education is, where do we draw the line in terms of cost? Okay. And maybe that's something that a lot of the listeners are perhaps facing. One of the great things about STCC is that we are affordable. Okay. Not only are we reachable, but we're affordable. And that makes STCC just an even better institution, our affordability factor. But what about people who want to go on for an advanced degree, for a baccalaureate degree or a master's degree or a doctoral degree? You have to think about the costs of doing that. And students are risking that cost. They're doing the cost benefit analysis and saying, well, it's worth my money and my time to do this. But when you look at student loan debt, it's a serious issue. How does the average person pay that amount of money back? Overall, between bank accounts and retirement savings, the median average household holds about currently holds about $11,700. Almost 30% of households have less than $1,000 in savings. Though this amount could vary drastically by age. It does vary drastically by age. But overall, when you look at American households across the United States, people don't have a heck of a lot of savings. In other words, we have many Americans living paycheck to paycheck. And that's something, if we can prevent that, we don't want to fester. Living paycheck to paycheck, and some of you may be feeling that right now. I know several people who live paycheck to paycheck. And what does that mean? It means that they're waiting for their next paycheck to pay off as much of their ongoing debt as they can. In other words, that paycheck, they depend on that, every cent of it, none of which is being saved, or very little of which is being put aside or saved for things like rainy day, retirement, funding our children's education, etc. All those things kind of go by the wayside because that check, we're using up the money immediately. Okay, that's living paycheck to paycheck. And frankly, that's a very scary feeling. So I'd like to encourage everybody who perhaps could be in that situation to think about it, or perhaps rethink it. Okay, and maybe we can discuss some ways to move away from that. Kelly? How do we protect and build our credit and our financial worthiness in 2021? Well, let's look at where we're at first, okay? 14 months ago, the pandemic hit. We were in a dire situation. The economy was, At that time, many of the businesses across the United States were shut down for a significant amount of time. Unfortunately, many of those businesses went out of business completely. When you look at the makeup of American society, 70% of businesses across the United States are small businesses. Yes, the corporations are the ones we hear about, Apple, General Motors, the big corporations. We hear a lot about them because they're always in the news. It's because they're such large entities. But make no mistake, small businesses make up the largest percentage of businesses across the United States. And when those small businesses are suffering and have been shut down, that makes our economy very timid, very unstable. We want to do what we can to keep our small businesses going. Although the coronavirus pandemic has led billions around the world to focus on protecting their health and their physical well-being, it also has affected people's financial livelihood and the well-being of hundreds of millions of people globally. The loss of income due to the closure of borders and businesses means that a noticeably large percentage of consumers have less disposable income to pay their bills. Coupled with the fact that approximately 80% of American households were living paycheck to paycheck before the pandemic even started, and the fact that we're kind of coming, we're about due for that mini recession. I guess some would say that, we're in a mini recession. The market has bounced back. It's fluctuating, but in general, the market has been fairly good. Recently, a couple of spikes downward, but overall, it's nothing like it was a year ago, okay? Many consumers immediately began missing payments on their credit cards, on their mortgages, and on their other debts. Thank goodness that rules were put into effect where it did not necessarily always result in people being evicted from their homes or losing their homes or being evicted from their dwellings or their apartments or losing their cars. Okay, because of the pandemic, a lot of things have, there have been laws passed to help Americans with this problem, but it's going to get back to normal soon. And those rules, those regulations, all the stimulus payments that you're seeing, oh, another stimulus here, another stimulus there, that's great. But at some point, all that is going to go away as we transition back into normalcy. And where is that going to leave the majority of Americans financially? Are they going to be better off or are they going to be worse off? We'll need to wait and see on that, okay? But right now, I can tell you that many Americans are struggling to make their mortgage payments, many people are on unemployment, are still receiving unemployment benefits. But what are people going to do to get themselves right again? Kelly? So ask yourself this important question. First of all, am I financially literate? Do I understand what it actually means to be literate, financially speaking? If not, am I willing to learn more about it so that I can effectively manage my future? Not in today's K through 12 schooling. I'll sometimes ask my students who take my personal finance course, did you receive personal finance or any type of financial management course in high school? And frequently the answer is no, we never received anything like that. I kind of look at financial literacy as more of a life skill than anything else. I do teach a course here at STCC called Personal Financial Planning, where we get in depth about how to invest, how to establish good credit, how to manage that credit effectively. We talk about lots of different things. We talk about insurance, we talk about investing, etc. But many students are not getting that before they're entering college. And it's important to be financially literate as early as possible, well before you get into college, because the savings and all the good habits, the good spending habits that people develop over a lifetime, they start early. What is my own current financial position? What do I own? What do I owe? What is my personal net worth? Am I saving money on a regular basis, or am I in debt? I'm going to stop there just for a moment. Ask yourself that question. Let's just pause for a moment. Are you saving any money? Or are you using all the money that you get in your paycheck to pay off your credit cards, to pay your rent, to pay for food, to pay for insurance costs, to support your children? Those things have to come first. But you also want to be able to put some money aside for a rainy day, for an event that may be unplanned for. I'm adamant to students, to clients, to anyone I speak to about, if you don't have a rainy day fund set up, set one up as soon as possible, because the unexpected happens. And when it does, are you going to be able to address it or not? Do I have a financial plan in place to ensure that I will have enough money to live on? Or am I living beyond my means? People are living longer these days than ever before. Back in the 1950s and 60s, the average lifespan for a man, I think, was probably about 58 to 60 years old. And usually women are, 3 or 4 years beyond that. But now people are, the average lifespan is somewhere in the 70s. And we have many people living well into their 80s, and in some cases 90s. And that's wonderful. But are you going to have enough money to live on over the course of 20 to 30 years post-retirement? That's an important consideration. How far out can you stretch your savings? Unfortunately, we have many people that don't have enough to get them through that amount of time. What's more important? Let's talk about the steps that you can take now to control your financial destiny. Kelly? I've put together some tips. These are high-level tips, but I really believe in these statements, and I'd like to talk about them with you. 5 tips to ensure your financial success. It doesn't really matter how much money you make. What's really important is, based on the amount of money you make, how are you managing it? A person that makes $40,000 a year has to be a better financial manager than someone who makes $140,000 a year. But both of those individuals, whether they make $40,000 or $140,000, still have to adopt a financial plan to ensure that they're living within their means. No matter what your income level is, you can always live above your means if you're not careful. The key is to live within your means. Spend less than you earn. That's a silly comment, isn't it? Spend less than you earn. How can you spend more than you earn? People do it. With credit cards, especially, people have a tendency, and we're all only human, but when the tendency is to spend more than you actually earn, that's how people get themselves into financial distress. And that financial distress is very hard to come back from. People will sometimes ask me in my class, Professor, can't someone just declare bankruptcy if they're spending more than they actually earn? We'll just declare bankruptcy, and we won't have to pay off those debts. My response to that is, A, it's incredibly hard to be declared insolvent or bankrupt. It's a court proceeding. And if you are declared insolvent or bankrupt because of your spending habits, because you've spent more than you've earned, it ruins your credit for many years to come. You essentially have to rebuild yourself. It's like starting over financially again. So I try to push people, and I have worked with people who have become personally insolvent, where their liabilities are more than their assets. They owe more to different entities, to creditors, than they own in assets, including homes, cars, etc. When that becomes the situation and insolvency and bankruptcy are the only thing to turn to, you're in trouble. So we always want to spend less than we earn. And sometimes you have to put this out on paper. You have to figure out how much you're actually bringing in from all your income sources and how much is actually going out. I have a spreadsheet. Perhaps we can look at an example in a little bit. No matter how much or how little you're paid, you'll never get ahead if you spend more than you earn. Often it's easier to spend less than it is to earn more. And a little cost-cutting effort in a number of areas can result in big time savings. It doesn't always have to involve making big sacrifices. I say this to my students in personal finance all the time. I sound like Mr. Doom and Gloom, and I don't want to sound that way. The students will often say, well, you're telling us not to do this, and you're telling us, no, I'm not. What I'm saying is, I'm going to take my famous example, the Dunkin' Donuts coffee. How many of you go out for a Dunkin' Donuts coffee at least once a day? I'll bet you 80% of us do that, okay? Let's think about the cost of buying a typical large Dunkin' Donuts coffee every single day of the week. So a typical coffee is about $3. If you do that 5 times a week, you're talking about $15 a week just in coffee, $60 a month, $720 a year just in Dunkin' Donuts coffee. That's a lot of money. If you were to take some of that money and curtail the behavior, not eliminate the behavior, but perhaps curtail the behavior back, instead of going out 5 days a week or 7 days a week for coffee, maybe 2 days a week or 3 days a week, okay? And then it also gives you something that you can look forward to rather than it becoming habitual. You'll look forward to that even more. And in the process, you could save a lot more money and invest that money into something that will grow into something much larger in the future. So a lot of financial planning is behavior centered. What are our spending habits? Do I really need to buy these things? Or is it more because it's a want? Okay, so it's just something to think about. You know, what is my tendency? What is my behavior? When I find something that I like, do I immediately purchase it? Or do I consider how badly I need it or how badly I really want it? Some people don't even think about it. They just buy. And I would encourage anybody who does that to try to change that behavior a little bit and at least think about it first. An example here, you're working part-time. You earn $100 a week after taxes, okay? We just got through tax season. We all know what the government does, right? They tax us on our income, both earned and unearned income. However, you routinely spend more than that amount each week on eating out, recreational activities, and you charge any excess or overage to your credit card. And even worse, you pay it off just a little bit at a time. You're spending more than you're earning. And by using your credit card and carrying a balance, you're actually spending even more than you're aware of because of the interest factor. That interest, which is money paid for the use of money. That's what interest is. It's money paid for the use of money. Bank loans you money. They loan you $5,000. What are you going to give back to the bank? Are you going to give the bank back $5,000? No, you're going to give them $5,000, which is considered the principal, plus all the interest that they're charging you. So the $5,000 loan, if it's a 10% interest rate, that $5,000 loan is going to cost you $5,500, okay, because of compound interest. it's important to realize that nothing really comes without a price. That's my first tip. Spend less than you earn. Number two, here's a big one. How many of us actually take the time to sit down and map out a budget? It takes time to do this, but I love to help people budget. It's a passion of mine. And sticking to a budget is a great thing to do in terms of managing your financial behavior, because there's nothing like seeing your financial situation out in front of you in tangible form. That's the best way to look at things in a very objective way, and it will have an influence on your spending behavior. How do you know where your money is going if you don't set a budget for yourself? How can you set spending and savings goals if you're not sure where that money is going? You need a budget, whether you make thousands or hundreds of thousands of dollars per year. It doesn't matter how much you make. Your monthly cash inflows. Let's talk about an example. Your monthly cash inflows from your full-time job after taxes are $2,000 per month. Your average monthly expenses, or what we call cash outflows, include rent, that's $800. We all have to live somewhere. That's very important. Food, $400. Gas and insurance on your car, $250. Cell phone and internet fees, $150. And maybe some other miscellaneous expenses. We'll call those $50 worth of miscellaneous expenses. What is your net cash flow? Okay, your net cash flow is $350. That's a positive number. That's a good thing. Whenever your net cash flow, which is taking your cash inflows and subtracting out your cash outflows, whenever that net or difference is a positive number, now we have something we can work with. Because that $350 can be used in many different ways. Yes, it can be used to go out and buy yourself or take a trip, or it could be used to buy yourself a whole new wardrobe. Or perhaps we could use part of that to buy our wardrobe, and we could take part of it and put it in a short-term savings account or investment like a certificate of deposit or a money market account. And perhaps we could take another portion of that and put it into a long-term retirement account, like a 401k or an IRA. These are things that I try to encourage people to think about doing. That $350 net, being a positive number, gives us options. And a sound financial option would be to have fun with a little bit of the money, invest in a short-term investment or a rainy day fund with a little bit of that money, and then take another portion of the money. Okay, we could look at the $350 in terms of thirds. Maybe I take $100 or a little over $100 and I buy myself, that pair of shoes or that wardrobe that I've been wanting so badly. Okay, great. Maybe I put the other $100 into a certificate of deposit that's earning 2 or 3%, and I lock the money away for a couple of years. And then maybe I take the other $100 and I put it into an individual retirement account, like a Roth IRA or a traditional IRA, which are great investments. That way, I'm hitting all my necessary goals. I've got some spending money that I can do what I want with, which keeps me happy. I've got some short-term money that I can get to in a relatively short period of time if I need to. And I'm also providing some stability for myself when I retire. Lots of people never think about retirement. They say, oh, that's 30, 40 years away. It comes up very quickly. Life moves fast. And if you're not set by the time you reach your late 40s, 50s, 60s, as you're starting to head into retirement, trying to make up for all that lost time is very difficult to do. I tell my students often, the number one advantage that they have, because most of my students are in their early to mid 20s, maybe some are in their late 20s, they have the benefit of time. They have a time horizon where they can build their wealth over time. And that is one of the most important things that you can have. So start early. Kelly? Those credit cards, it's a double-edged sword, okay? Credit cards are very much a double-edged sword. They're a blessing and a curse. Lots of people will say, do we really need credit cards? And my answer to that is, frankly, yes. I believe that there is an important aspect to credit cards, especially when you're young. Setting yourself up and building your credit in a positive way is something that every young person should think about doing. Even if you're not, in your 20s anymore. Maybe you're in your 30s, okay? Maybe you're contemplating buying your first home, or perhaps buying a new car, whatever the situation might be. You're going to need some sort of credit history in order to get the loan that you're looking for. Where does that start? It starts by applying for a credit card. Students out there are many credit card companies that are willing to give a credit card to students. They want your business, okay? And they will give you special types of credit cards, student incentivized credit cards that have all sorts of benefits that appeal to students. So including usually a very low rate of interest. So I always encourage students who have not yet applied for a credit card. As long as you're 18, you can apply for a credit card. Doesn't mean you're going to get it, but you can apply for one and apply for a student credit card. And when you get that credit card, what you want to do is you want to start to make very small purchases and pay them off timely, okay? The worst things that you can do with a credit card to get yourself into financial trouble, keep carrying a large balance from month to month. Keep carrying a large balance. That is one of the worst things that you can do. Although if you're paying off the minimum amount, it's not ruining your credit. You're incurring a tremendous amount of interest, and you can't write that interest off in any way, shape, or form. You're not going to get that money back. It's not a business expense unless you have a business. It's lost money. So what you want to do to build that credit is to make small purchases that you can pay for when they come due immediately, and then start over. What's that going to do for you over time? It's going to give you and establish for you a positive building credit score. Okay, so paying off your credit card debt is very important. Now, let me just talk about the other side of credit cards. If you have credit cards and they are out of control and you're getting calls from creditors, like many people do, how do you manage yourself out of that? That's a scary feeling. The best thing to do is to take all your credit cards. First of all, stop using them to purchase. Focus on paying off the balances on those credit cards. You may want to talk to a debt consolidation company that will help you to consolidate all your credit cards into one single loan payment that you can pay off in a certain amount of time, and you can put this behind you. That might be an option for people who are in a tremendous amount of credit card debt. But normally, if you're not in dire straits, the most important thing you can do is stop purchasing using those credit cards and focus on paying the minimum balance or more, preferably more, each month. And it will start to knock down that amount that's due. In other words, if your minimum payment per month is $20, you can pay $40 on that. And you will pay that credit card off in half the time that it would have otherwise taken you to do that. What are you going to save when you do that? A lot of interest. You're going to save yourself a lot of money. People do this with mortgages all the time. They'll have a set mortgage amount and they will make additional payments on their mortgage throughout the year. I've done this now for 20 years. I've been making 2 to 3 additional payments each year. I've budgeted our family so that we can pay the mortgage off in 20 years rather than 30 years. So what I've basically done is I've taken a 30-year loan and I've gotten it to the point where we should be able to pay that mortgage off in the next 3 years, which will be the 20th year. And in doing that, I'm only telling you that to reassure you that I'm putting my money where my mouth is here. I practice these same things. And what I have calculated is that it saved me approximately $80,000 over the life of the loan in interest. That's the benefit of paying things off quickly if you can. If you're in any type of debt, try to pay it off. Make that your first priority. Pay the debt off. Lots of people ask me, should I invest? If I have some net cash flow and it's positive, what would it be better to do? Would it be better to pay off my debt or invest the money? If I invest, I'm going to make earnings on my investment. If I pay off my debt, I'm going to make out by lowering the total amount of interest. Without a doubt, don't use the investment route. Pay the debt off first. That's what being liquid. We want to get ourselves as liquid as possible, as solvent as possible. We want to pay off the debt first. And then once the debt is controlled or paid off, any excess can start to be invested. They give an example here. You use your credit card to purchase a new stereo system costing $360. Your credit card has an applicable rate of interest of 18%. That's about average. Instead of paying off the entire balance due, you decide to pay the minimum monthly amount of $25 a month, expecting that you will have the entire balance paid off by month 15. Not true. Because you're paying just the minimum balance each month, and due to the compounding effect of the 18% interest rate, which is an absolute killer, it will actually require that you make 17 more payments on top of your original 15 to pay off the entire amount. And you'll actually pay $49 in interest on top of the $360 price point. So that stereo that you thought you could pay off in about a year and a quarter, 15 months, is actually going to take you well over 2 years to pay off, and you're going to pay $50 extra just by lengthening out the life of that payment structure, that loan. That may not seem like a lot of money, but it is when you do this in multiple ways. And it does become very significant when we're talking about not hundreds of dollars, but thousands of dollars, and in some cases, tens of thousands of dollars. That multiple can just get easily out of control. So we want to pay off the debt first and foremost. Kelly? Set up a short-term savings plan for yourself. What is a short-term savings plan? Well, you've heard it before. Pay yourself first. If you wait until you've met all of your other financial obligations before seeing what's left over for savings, chances are you'll never have a healthy savings account or investment. Resolve to set aside a minimum of 5 to 10% of your salary for savings before you start to pay those bills. Now, again, this kind of goes against what I just said, pay off the debt first, right? But that's for a situation where your debt is getting out of control. It's becoming unmanageable. If you are fully in control of paying off your monthly mortgage, your car payment, rent if you happen to be renting, your food, other expenses that we all have. If those are controlled, if you're able to pay them, not living paycheck to paycheck, but you're able to comfortably pay those expenses off and have a positive net cash flow every month, this pertains to you. Now it's time to think about setting up a short-term savings plan. So in terms of retirement and short-term savings plan, we want to set up a short-term savings plan first, and then we worry about the long duration later. Not that that's not important, it is, but what's immediate is more important than what's 20 to 30 years down the road. So setting up a short-term savings plan, 5 to 10% of your income put aside each month and invest it. Example, you make an annual salary of $24,000 a year, and your net cash flow after your expenses have been paid is $200. We have a positive net cash flow. That net cash flow does not have to be positive, by the way. It can very easily be negative, and that's when we have concerns. But in this case, we have a positive net cash flow of $200. After some time, you've put aside $500 that you want to invest in your future. You resolve to invest the $500 into a one-year certificate of deposit at 3% interest guaranteed. If you don't know what a certificate of deposit is, a certificate of deposit is usually, you can get it through your local bank or credit union. They're usually for short durations of time. In other words, your money is not locked up for any tremendously long period of time. CDs come in 3-month, 6-month, 1 year, 2 year, 5 year increments. The key is the longer you invest, the longer the time duration, the higher the interest rate is going to be. Okay, so in this case, it's a 1-year certificate of deposit, and you're earning a nominal 3% on that investment. Okay, but consider after 1 year, you can take the money out. There's no penalty for taking it out as long as you satisfy the 1-year requirement. Incidentally, if you needed to dip into that CD before the year was up, you can do that. You have the right to do that, although you will be assessed a penalty to do that. If you look at that investment, that $500 investment, if it's invested for 3% after 1 year, you're now going to earn $212.90 in interest on that investment. So the total net worth of your investment at the end of year 1, beginning of year 2, will be $712.90. So you've made $212.90 in interest on your investment by locking your money up for 1 year, and you probably wouldn't even miss it. Now think about doing that each successive year. And now through the wonder of compound interest, you're building on that investment so that at the beginning of year 2, your starting point becomes $712.90. Let's say you go to the bank and you say, I want to renew that certificate of deposit, put it in for another year, 3%. Now you're earning 3% on $712.90. And that's going to grow to an even higher amount. The beginning of year 3, you'll start with that higher amount and you'll earn 3% on that. That is the magic of compound interest. It is building through the compounding effect of interest and principal. Setting up a short-term savings plan is very important. I want to say one thing with respect to this. Liquidity is the key. Accessibility is the key. Short-term savings plans are designed to earn you some return, but still have you be able to access the money if you need it. That's the rainy day fund idea that I was talking about earlier. A rainy day fund is actually best put into an immediately accessible account, like a savings account or a checking account. A certificate of deposit is an investment account in which the money is locked up for a certain amount of time. So it's not immediately accessible, but relatively speaking, the time duration is short. Kelly? You've got your rainy day fund set up. Okay, so you're driving down the street one day and you hit a pothole and your car, the axle on your car breaks. Okay, you can't drive it. You tow it to the garage. The mechanic said, well, that's $1,000. What would most people do? They would whip out a credit card and say, I'll put it on my credit card. And by the time they pay that $1,000 bill, over time, it may cost them $1,200 or $1,400, but not if you have a rainy day fund set up. A rainy day fund is supposed to be there for emergencies, unexpected occurrences that as part of life, we all experience. You're driving down the street, you hit a pothole, $1,000 car bill, okay? Let's say that now instead of using your credit card, you can dip into your rainy day fund and pay for that expense. Guess what? You don't have any interest to worry about. It doesn't have to be car related. It could be medically related. It could be just something unforeseen, okay? Have the rainy day fund set up. What you fill that fund up is entirely up to you. I like to tell people to put in a nominal amount of money into a rainy day fund because you don't want to lock up thousands and thousands of dollars that you could be investing and earning a return on in a rainy day fund. Anywhere between $1,000 and $2,000 in a rainy day fund should be more than adequate to cover the unexpected occurrences that might happen throughout the year. And then at the end of the year, it's a good idea to see how much of that money you've used and build it back up again if it needs to be built back up. But let's say that the rainy day fund is established and you have a short-term certificate of deposit savings plan in effect. Now it's time to think about the long term. It's time to think about 10 years down the road, 20 years down the road, 30 years down the road. Depends on your age, but consider setting up a long-term retirement plan. If your employer has a 401k plan and you don't contribute to that, that's a big mistake. I know many people who have 401k plans that are being sponsored by their employers. And in some cases, the employers are matching up to a certain amount of contribution based on what the employee is contributing. If you don't take advantage of that, you're passing up free money. You're walking away from one of the best deals out there. Ask your employer if they have a 401k or some type of profit sharing plan or similar plan and sign up today. If you're already contributing, try to increase your contributions over time. Hopefully, as your salary grows and your experience grows, you'll contribute more into your long-term retirement plan, and you will build a nice nest egg for yourself in the future. If your employer does not offer a retirement plan, not every employer offers one, consider an individual retirement account or an IRA. IRAs are perfect for individuals that are either self-employed or they do not have the sponsorship of a 401k or a 403b plan. Here's an example. You're 20 years old. You just graduated from STCC's business program, okay? #2 online program in the country, by the way, and landed your first job. Congratulations. Your new job is going to pay you $30,000 a year. And after 6 months of employment, there's usually a period of time, a statutory period of time that you have to wait before you can start to contribute to a retirement program because the company wants to know that you're going to stick around. But after 6 months, you'll be eligible to start contributing to the company's 401k retirement program. And your employer is going to match your contributions up to a certain amount. Usually the match is up to about 6%. That's usually where most companies cap off their match. Consider this. If you were to invest just 5% of your annual income amount into the 401k plan, through automatic monthly payroll deductions, $1,500 a year, or about $125 a month, and your employer were to match your contribution amount of $1,500 a year, you're really saving double that. You're saving $3,000 a year. And that actually equates to 10% of your annual income. By the time you're 60 years old, 40 years from now, notwithstanding any applicable interest, you will have earned, get this, $120,000. You will have saved well over $100,000 without even noticing it. That is absolutely huge. So I would definitely encourage anyone who is not taking advantage of a retirement plan through their employer to find out about that immediately. Don't wait. If you are eligible, start to contribute as soon as possible. That is a portable retirement plan. 401ks can go with you. Okay, just because if you part ways with an employer, either voluntarily or involuntarily, okay, they won't keep matching you, okay? But it doesn't mean that you have to take your 401k out of the investment plan, okay? They can't make you do that. So you can stay in the investment, okay, and have the investment grow without any contributions. But if you're employed at a company that, and you're staying there and you're doing well there, it is a no-brainer to get involved in the retirement program, regardless of if they will contribute to it or not, okay? Be involved in your company's retirement 401k or 403b plan if you happen to be a municipal employee or a state employee. There's a different plan in place for state and municipal employees, but they work congruently with one another, essentially the same type of plan, 401k, 403b plans. To recap, okay, I'm going to go back, use my financially literate motto here. I must be willing to first understand and then implement basic skills that'll set me on a path to securing my own financial future. There is no better feeling, or very few better feelings, than being financially secure. When you are not financially secure, it causes uneasiness, undue stress, worry, and may even shorten your lifespan. If you are financially secure, that's not going to happen. You have to be honest with yourself, however. If you're in a bad financial situation, be honest with yourself and say, I'm not doing what I could be doing or what I need to be doing. You have to be upfront with yourself. That may mean changing a few behaviors as well. Those behaviors can become conditioned over time. I say this because I was this person, okay? I won't say that I was abusive financially. I've always been a saver and a planner, but there were times in younger days when I was working and I was buying breakfast, lunch, and dinner out every day because I was on the road or doing one of those things. And I started to think about how much money I was actually losing by doing those things. So I changed my behavior just a little bit. I didn't miss it at all. And I was able to save a lot more money over the years. And I put that money into in different investment accounts. And I'm happy that I did that. I'm happy that I looked at myself objectively and said, I need to make a few changes here. You have to be honest with yourself, and you have to strive to always improve your financial position. It's never ending, okay? It doesn't stop. Your fiscal management processes do not stop. Over time, they should just become more and more automatic. So I'm gonna go to my 5 Ps, okay? This was actually given to me by my uncle, who is one of my great role models. And my uncle said, one day he said to me, do you know what the 5 Ps are? And he happened to be an engineer, and he was a manager in the engineering industry. for many, many years. And I said, no, I have no idea. Proper preparation prevents poor performance. If you think about that, it sounds corny, right? But it really makes a lot of sense. If you prepare yourself properly, especially now where you have the time to do so, you're going to prevent a poor result in the future. That goes for everything. It goes for your finances. It goes for your studying in college. It goes for different aspects of your life. But the 5 Ps, I hope if you take nothing else away from our segment today, you will take this little acronym, I guess you could call it, the 5 Ps. Proper preparation prevents poor performance. What's the moral here? The actions, the things that you do speak louder than any words that you could ever put on paper. Start planning right now and resign yourself to the fact that it's never too late to start. That's an old cliche, but it is so true. It's never too late to get yourself back on a financial pattern, a good one. Remember a couple of things. Live within your means, okay? Especially now in this pandemic-based society that we live in, okay? It's very important to live within your means. Budget yourself. Put the budget down on paper. Don't just say, I'm going to budget myself and think about it in your mind. You need to put it down in a spreadsheet or on paper or in some type of a logbook. You need to measure your cash inflows. That includes earned and unearned income. And you need to measure that against your monthly cash outflows. This should be done on a monthly basis. Monthly cash inflows minus your monthly cash outflows equals your net cash flow, a number which could be positive or negative. If it's positive, you have alternatives of what to do with that leftover money. If it's negative, that's when you have to start to think about changing some of the behaviors or paying off your debt so that you can get yourself back into a positive number. Pay those credit cards off. Don't carry a balance if you can help it. But if you're establishing your credit, it is important to make purchases every so often and pay them off so that your credit builds. If you're someone like me, okay, or if you're in your 40s, 50s, and you already have a solid credit history, you've built the credit history. The most important thing you can do at that point is not ruin it. But when you're younger, the most important thing that you can think about is building your credit so that when you go to apply for a loan, you can secure a very low interest rate. Having good credit coincides with getting a moderate to low interest rate. And poor credit usually results in either not getting the loan at all, or perhaps getting the loan that you're looking for, but at a tremendously high interest rate. So what we want to do is establish the credit up front so that your credit score, your FICO score, is high. Okay, and by the way, I didn't describe what a good credit score is. A good credit score is anything over 700. A poor credit score is around 350. Okay, so anything in between is an average credit score. You want your credit score to be above 700, if at all possible, which is a good indicator that you are financially solvent and a good risk, which will usually end up meaning a lower interest rate for you. Establish a now savings plan and establish a later savings plans. These are basic things that you can do to set yourself up for financial success.
Awesome. Thank you so much, Anthony. That was awesome. Round of
Thank you.
applause here from our muted cameras. We actually
rang right at the left, right at the right time.
We actually do have a question, and I think you have an answer for it. And it comes from Barbara. Do you have any suggestions on getting started on making a budget plan? I find the whole process so overwhelming that I talk myself out of it before I even get started. How can I get motivated?
Barbara, you took the words right out of my mouth. And one of the things that perhaps Kelly can put up on the screen is, I call it an easy budget plan. It's an Excel spreadsheet that I developed that will help you. You can do this monthly, you can do it weekly if you want, but it makes more sense to do it on a monthly basis since more of our expenditures are monthly based. And basically what it does is it breaks down all the different categories of income, which would be considered cash inflows that most people have, as well as all the expenditures or cash outflows that most people have, yielding a net cash flow each month. So a good starting point, Barbara, would be to look at the bills that you have on a monthly basis. Those would usually include telephone, rent, credit card, mortgage, all those types of things, food, and weigh that against what your monthly income amount is. Now that monthly income amount would be after the taxes and the withholdings are taken out of your paycheck. So that would include any Social Security and Medicare, which we call FICA taxes, okay, which are automatically taken out of your pay by your employer. Everyone has to contribute 6.2% into Social Security and 1.45% of their gross earnings each pay period into FICA. There's also the unemployment fund, the FUTA fund, okay, federal unemployment, state unemployment. So these are other withholdings that if you look at your pay stub, you will notice are coming out each period. Not to mention other withholdings like federal and state withholdings that people have, as well as other types of deductions that people have coming out of their monthly pay. If you are contributing to a retirement plan, that will be deducted. Union dues, if you happen to be in a union, that may be deducted. So what you want to do is you want to take the bottom number, the leftover amount, that would be your monthly cash inflow. Okay, and if you're being paid bi-monthly or twice a month, you would double that. And that would be your monthly cash inflow amount. Okay, but you have to add to that any interest income that you have coming in on bank accounts, any dividends. If you own stock, you're gonna perhaps be receiving dividend payments. Any withdrawals that you make from your savings or your checking account, and any other sources of income. Some people have 2 and 3 jobs. So you might very well have other sources of income. The income category is both earned and unearned income. Your expenses, again, rent, mortgage, groceries, car payment, cell phone, internet, and do this for 1 month. And then you will see what you're left over with after that month. And then start to do this for the next month. And then eventually for a quarter or 3 months. Once you have a year's worth of data, it will be much easier for you. I think Kelly had mentioned that you find this process cumbersome and time consuming. Once you get a full year's worth of data, it's going to be much easier to carry this process forward. You may have to just make a couple of changes in the spreadsheet and it will automatically calculate your monthly net cash flow. And as long as that net cash flow is positive, you can take that money and decide what you want to do with it. Do I want to invest some of it? Again, I would encourage short-term investment first. Then think about long-term investments if you haven't already done that. Set up a rainy day fund, meaning liquid, accessible money that will only be touched in the event of an emergency so that you do not have to go to a credit card. What I'm saying is we do not want to be pressured into using a credit card. We want it to be our choice. If we want to use our credit card, if you go out for dinner one night and you want to use your credit card, fine and dandy. But you don't want to do that through being coerced or pressured to do that because you have no other alternative. So that would be what I would suggest here. And once you've built a full year of data, you're only going to have to make a couple of subtle changes. You can resave the spreadsheet. I can certainly pass that on to you, and it'll make budgeting and it'll make tax planning as well. I forgot to mention, the tax planning aspect. This is not I also teach income taxes in, been doing income taxes for 20 years as an accountant. This makes a great tax planning tool as well. So I hope it's helpful to you.
This is great. Thank you. And for those on the line, I will share this via email after the presentation. So thank you.
Please do. Please do.
Great. A couple more questions. Kimberly asks, are secured cards a way to rebuild credit, and is Credit Karma accurate?
Yes. By secured cards, you mean secured by some type of collateral. Yes, the loans are generally secured, or any type of debt is generally secured or unsecured. If it is secured, it is backed up by some form of collateral. If it's unsecured, it is not. So it's always better, if I'm reading the question correctly, to try to obtain a secured loan. Okay, in other words, the bank will usually offer, the lending institution, whether it's a credit card company or a bank, will usually offer a much lower rate of interest to you for a secured situation than they would for an unsecured situation. So if you default on the credit card or the loan, secured means that your assets could be encumbered by the creditor. They can take an asset to replace the loss in value of you defaulting on the credit card or the mortgage loan. That will use, because they have that security, because the lender has that security, that you bodes for a much more respectable rate of interest. On unsecured debts, because they have nothing to secure it, the alternative is for them to issue a much higher rate of interest that you would have to pay to cover the potential loss in the case of default. Keep in mind that mortgages, as an example, just as a long-term debt, 20% of mortgages end in foreclosure because people are not paying the debt. That's why PMI became so important for mortgage companies. If you have not established at least 20% equity, or if you're buying a home and you're not putting down at least 20% of the value of the loan, they're going to charge you PMI on that until you get to 20%. It's because of the rate of default. So the way it works is that secured loans will usually end up giving you a much better deal in terms of a lower interest rate. Unsecured loans will usually entail a much higher interest rate. And the Credit Karma, I believe that's a credit source, like different credit scores that you can pull. I've heard good things about Credit Karma, and I think they are dependable. So if you run a Credit Karma score run, that should be pretty accurate. I've heard nothing bad about that, about Credit Karma.
And Keith just mentions Credit Karma is a great tool, but also important to compare scores and info against your card accounts and the credit bureaus directly. There are different types of credit scores, a common one for weights, payment history on car loans a little differently. So
absolutely. Comparing your credit score to other sources is super important to ensure that they're consistent. Okay, so very important to do this when you're building your credit score. I keep saying that because so many people, they're 25 or 30 years old and they haven't taken active steps to start to build their credit up. So when they do need a loan of any type, an educational loan, a car loan, a mortgage loan, they're not going to be able to get it. They're going to have a very hard time, or if they're able to secure the loan, they're going to have a cosigner in most cases. You would have a cosigner on the loan if you're under a certain age anyway. But if you do not have a good substantial credit score, they're probably going to have someone else co-sign the loan at a tremendously high rate of interest, something you can avoid if you start to build your credit early. And again, the key, make small purchases that you're able to pay off in a timely manner over time. And keep doing that over time.
I also wanted to let folks know that the credit report companies, there's 3 big ones. they often, especially during COVID, have allowed for free pulls of those reports. So check it out. I don't know if it's still going on, but it was for a while there, and it just kind of allows you to look at your past history of credit and what's on there. And it also allows you to review if there's anything that should be inaccurate that you can, challenge, and they can take that off if it is in the case. So, and many credit card companies today even offer you the FICO score for free as part of your package. So check that out, because that might even be an option that you didn't even notice was there. So just something to think about. Okay, so Jen has a question. What is the amount you would suggest to budget for the rainy day fund to avoid the credit cards?
I like to tell people 10% of your monthly expenses. So if you add all of your monthly expenses together and you take 10% of that and you put that into a rainy day fund, that's usually a good amount of money to keep in the rainy day fund. It's not a good, rainy day fund is a lot like a petty cash fund would be for a business. It's meant to be on hand and to pay for small expenditures as they come up. So having too much money in there really ties up capital that you could otherwise be doing a lot more with in terms of short-term and or long-term investing. So it's a good idea just to take an estimate of what your monthly expenses are, 10% at the most, 15 or 20% of that number is a good rainy day fund to keep on hand. And you don't need to keep replenishing the rainy day fund if you haven't used it. As long as your expenses remain the same, consistent, it's not like you have to keep building up a rainy day fund. That's not a fund you keep building up. It's a fund that you replenish as necessary, so that in the event of something happening, an unforeseen circumstance in which you need to come up with money very quickly, you won't have to go to the credit card, and you won't be forced to go to the credit card unnecessarily.
Great. Gladys wants to know, what is the most significant difference between the 403B and the 457 SMART plan?
There aren't a lot of differences between those plans. So the 457 and the 403B do have different tax implications, but they don't have much difference in the way of how they're contributed to. So, without going into a lot of detail, there's not much of a difference between those two. Those are outside of a corporation, so those are usually given to someone who's employed by a municipality or the state. But in terms of the contributions and what you can contribute, maximums, etc., there's not a lot of difference between those two. However, some of the differences do arise on the tax end.
Okay, and Lisa asks, and this is in regards to the credit report I just mentioned, don't pulls hurt your credit score? And my thought initially is they do, but not, I think, if you do it on your own, but correct me if I'm wrong.
Yeah, if someone pulls your credit score for you, like if you're going for a loan and someone pulls the credit score for you, I think that detracts from it. Like if you're applying for a mortgage and the mortgage company pulls your credit score, I think potentially that could lower it. But if you do it to check your credit score periodically, pulls don't have a negative effect on it.
And same thing when you check, I think, on your credit card, the FICO score, that doesn't
Right.
at all. So
yeah, self-checks don't have a negative effect on the credit score. But when other entities or creditors check your credit score for credit reasons, okay, for underwriting based reasons, okay, it does.
Good to know.
The extent of which I'm not quite sure how much of an effect it has, but it does have some effect.
Great. Any other questions before we wrap up? This has been tremendously wonderful. Thank you very, very much on behalf of everyone here. And of course, on behalf of the STIC Foundation, thank you all for joining us tonight. And of course, please feel free to join us on June 1st for our final presentation of the series, and that is a wellness seminar with Sheila Magala's class of 1980, her owner of Heart Song Yoga. So we will do a little bit of relaxation, which I'm sure we'll all be looking forward to after a hectic May month. So thank you again, Anthony, and thank you all so much for joining us. We really appreciate it. Take care.
Thank you very much for having me. This was great. And if I can ever help anybody, please just let me know, and please pass that document on to anybody that would like it.
Will do. Thank you very much. Take care, everyone. Have a great night.
Thank you so much.
Thank you, Anthony. Great job.
Thank you.
Thank you.
Thank you very